Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. I'm delighted to welcome Lo Hornbuckle with GoodHorn Capital. Welcome to the show, Lo. I appreciate you taking time today.
Yeah, thank you so much for having me.
Incredible. Thank you. And Lo is with GoodHorn Capital. They do investments passively. It's a capital equity firm. They are investing in assisted living built to rent models. They, obviously have the assisted living, division within them. Their assisted living division called Sage Oaks Capital, which I think is championed by Lo here. And he has good bit of experience. He has 5 locations himself in Dallas with 40 beds there. Their boutique company is such a good dealer in that space that I kind of was inspired to invite him and see and kind of share the content. Perhaps it would be a great conversation, and we'd love to kind of hear some nuggets from Lo here.
Sure.
So with that, Lo, help us get started as to kind of how you kind of came about in the space, and also how you kind of took turn into partnering with your partner and forming GoodHorn Capital as well,
Absolutely. How much time do we have? No, I'm just kidding. So the deal with me is that I worked at a car dealership for a long time. So mostly ran the finance and insurance department. So I was the guy that everyone hated, but
Sure.
I mostly wasn't that guy. I mostly managed those people. It was a great experience because I learned how to sell. I learned how to, run a service business. Because the truth is, if you go buy a Honda somewhere, they're all the same, right?
Sure,
so
sure.
you have to go where it makes the most sense. So I really understood fundamentally kind of, what a unique selling proposition meant. Learned a lot about risk, who was credit worthy, who should we give loans to? And that was a really important thing to do. And then learned a lot about relationships, right? Because you're talking to, not so much from the customers. I think the customers are an important relationship, but if someone buys a lot of cars from you, they're going to buy one every couple of years. But every day I was talking to the banks who were loaning money, and so I was having to build relationships with them. That was pretty fundamental in my development, I think. But, I always realized that, if you own a car dealership, my particular owner was kind of hands off, and he was in the business, but he was hands off, and he spent a lot of time on vacation and playing golf and having this great life. And there was a general manager. He's a good friend of mine, and that guy worked hard, and he worked really hard all the time. And he was never. So I realized, basically, even if I get promoted into the dealership, I'm going to give myself a job.
Sure.
And I was like, what's the point of making money if you can't enjoy it?
Sure.
So I set out to kind of start my own company, and just unfortunately my dad passed away and had a really bad experience on hospice. And I don't want to say it's linear. I didn't start Sage Oak because of my dad, but when I stumbled into the opportunity, all those old emotions and all those old feelings and all those things kind of came back into play for me, and it enabled me the opportunity to sort of take what happened to me and turn it into a positive for other families. That's kind of how Sage Oak got started. And I'm happy to answer the question about my business partner, but you may want to follow up on this. But I met Austin, basically because he's an expert in construction, and that was something I felt like our company really needed.
Sure. And there are a lot of good bit of nuggets there, Lo. Your point about, sort of that seed of inception, as we call it, right? I mean, was that the hospice experience, and those experiences kind of lay those, inception seeds, as I call it all the time, is that something tickles you and something you say that, hey, this is not right, and this has to get something better. And I'm sure your Sage Oaks memory care business now was perhaps a result of some of those sort of inspirations or experiences that you took to heart and say that, hey, I'm going to like kind of replicate this and make it better as well. Another point I think you said, which I really like as well, just kind of hearing you being in that car dealership space and being the finance insurance guy, and you're seeing all the various people, the systems, the people around you that come through, the credit worthiness that you said of the customers. That's so critical that you're analyzing and you're betting on people, and you want to make sure that your customer is right. Like, for example, in our business, I'm kind of the property manager. We look through, similar model. People are trying to rent or lease or buy cars or, your rental houses. You're looking at credit reports. You're kind of seeing, hey, is that the person worth taking the risk? Do you think they'll kind of pay the long term, whether it's car, whether it's, sort of your rental houses? It's the same kind of philosophy. There are a lot of parallels. Would you agree to that, Lo?
Yeah, no, I think learning how to read between the lines and learning when someone says one thing, what they really mean. And so it was a good experience. And then just kind of figuring out which customers you didn't mind vouching for, putting your reputation on the line, which customers you didn't want to do that with. And there were some really great lessons. I mean, one of the interesting things about it, the people that paid more for the car, they were almost always happier. It's funny, the people that come and spend all day negotiating and they're like, I'm not that happy. Well, no kidding. You spent all day here to save $300. But the people that paid more oftentimes were happiest, and they just came in, bought the car they wanted, and went on about their days. So it was, you got to see a lot of different styles of people, and you got to see, some people think negotiations being mean, right? Like if I'm going to negotiate with you, then I'm going to be rude to you. I'm going to be cruel to you. And
they want to win.
That was kind of so. Well, even then, I mean, there's plenty of people that want to win, but they're nice about it, right? It's just because it's numbers. It's just a piece of metal with some tires and some numbers. And so it was funny to see all the different personalities and, kind of put them in categories and just people, all how they handled themselves. And it was a great place for me to learn a lot. And I loved what I did. Ultimately, I'd probably still be doing it if I saw a reasonable path to owning a dealership. It's not that easy. And a lot of the manufacturers, have a very clear picture about who they want to own dealerships and things like that. And it probably wasn't going to be me. So once I kind of realized that was the case, then it was like, okay, well, maybe I want to go start my own thing, and give myself an opportunity to build something in my image or build something that I think that serves customers in the way that I want it to.
Sure. Now let's fast forward that tape, Lo, as to, now you have 5 locations with Memory Care, your company, Say Jokes, right? Could you maybe kind of, play it forward and kind of give us some stepping stone that when exactly was it, was clear to you that, hey, I want to be in this Memory Care, space, and I want to make this better. And 5 locations for our viewers and listeners, I want to kind of, underline and bold the statement here is that owning Memory Care is extremely stressful, capital intensive. There's people involved. There is timeliness. There's just so much regulation in all of this. So for someone kind of coming from, let's say, a car dealership side, and coming into this space, help us kind of fill in those blanks as to how all those different touch points happened in all of this.
Well, that might be beyond the scope of our show, but I'll definitely do the best I can.
Sure.
So, I really kind of made the decision. What was kind of funny. I actually thought I was going to start an apartment syndication company. So probably, let's say, June of 2015. I thought I was going to start an apartment syndication company. I was at a conference being hosted by a big multifamily company that I just finished working for. So one of the things that I'd done is I said, well, if I'm going to get into the apartment business, I need to learn how to be a property manager. And so I actually took a job. I invested with a company and then took a job as a property manager, not the property that I invested in, but just to learn the business.
Sure.
And I did not like being a property manager at all. It was terrible.
Sure.
And so I got their occupancy. They were 88% when I got there. When I left, they were at 93. They're in the process of selling. I didn't stick around. I just said, hey guys, I think you're in good hands and good luck in the sale. But I went to an event they were hosting, and they were talking about, senior housing being the future. And I'd never thought about that before. And frankly, I don't necessarily, I would say that prior to 2015, I had my grandparents and I had them, and I really loved them and cared about them, but I wasn't the guy that would like stop and help an elderly lady across the street. I didn't think like that.
Sure.
Now my whole paradigm is different in how I approach society. And a lot of people that have known me for a long time have commented that I'm different since I started the company. Right.
Sure.
So I've literally spotted a lady in my neighborhood that had dementia and was wandering, and just the signs resonate with me and kind of like stop to help her. But I would have never done that prior to 2015. I would have had no bearing or anything like that. So in 2015, that kind of got in my ear. And then by November of 2015, we bought our first house that we were going to convert into an assisted living facility. We toured a bunch of different facilities and decided, okay, here's what we want it to be. And to this day, I think some people will tell you it's probably the nicest facility in Dallas. And that was my first one. And then I bought an operating one that was struggling, because my career has really always been about buying facilities that weren't doing well. There's kind of a disconnect, in my opinion. Most people that are selling small assisted living facilities, if they're doing well, they want so much money that the financials don't really work. But you can go in and buy one that's struggling. And with my background in sales and marketing and that kind of stuff, that part wasn't the big fear for me. So I kept buying struggling properties. So the average occupancy of the 3 facilities that I bought were 33% occupancy. So they're not doing well. And stabilized those 2 locations. Those were corporate-owned stores. And then we went out and raised capital for the first time. So I'd have private investors before, but I'd never gone out and had multiple investors for projects. First time I did syndication was in 2017. And so we raised a couple $1 million to expand our company from 2 locations to 5. And then, and then we stabilized all those and found some success and paying investor distributions on the ones that are syndicated. And then we said, okay, we've proven the concept. We've proven we can do this. Now let's go build our dream. And our dream was a campus of care homes. So you pull up into a neighborhood, instead of, houses for families, these are 9,000 square foot mansions that have 16 people living in them, and they're all on one campus. And you have an administration building, but it looks like a neighborhood. And so we wanted to build essentially a big building that was broken up into little buildings so that you could have all the benefits that come with small facilities, but all the scale and all the benefits and all the financing that come with, 200 bed, 100 bed facilities. And so we have 2 of those projects going now. They're in various stages of construction. Those will both be coming online next year. We'll start filling those. And so those will kind of be our crown jewel. And we're very excited to offer those to the markets that we're in.
Sure. So that would be a large sort of a colonial luxury, mansion style assisted living. Does that sound about right? Yeah,
I mean, they're traditional houses, but they've been purpose built for that. So each house has 16 people. I mean, just in terms of dollar amount, I mean, one project is about 15 million, and the other one's about $18 million development.
Wow.
So they're pretty big projects.
Sure. And how big is the sort of the square footage of these buildings?
Yeah, so each building is about 8,500 square feet. I have 80 beds in one and 96 beds in the other. So the 2 developments combined are just about 100,000 square feet, roughly.
I see.
One's about 50, one's about 50.
How many buildings is that within one phase, by the way?
So in our project in Louisiana, is 6 buildings, an admin building, and then 5 16-bed care homes, so 80 beds. And then our project in Denton, it's 7 buildings, an admin building, and then 6 16-bed houses for a total of 96 beds in that phase.
I see. Very interesting. So this is where I think you combine your memory care and the new construction with your partner. Would that be right?
Yeah, I mean, so in Lake Charles, so my partner Austin is active in our Denton community, and I think we started out kind of as a joint venture, and it's kind of become a partnership over time, and that's really a testament both to him and his team and our ability to interact and get along. I've been in a lot of partnerships. I've had some partnerships that have lasted, for 15 years. So I've been in partnerships that have been very good, but finding a partner that that you trust completely, that you want to grow with, that kind of balances you out. It's difficult to do. And I've been very fortunate to have a lot of those throughout my career. But, ultimately when I was building in Lake Charles, what I realized is not having construction and development in-house was a hindrance.
Sure.
And by that, I mean, look, I've got a great construction development partner in my Louisiana project, but he doesn't live in the market. So he's not actually hands-on doing those things.
Sure.
And so the great thing about my partnership with Austin is that he was already actively building and developing in the market that we're in together. And so, he knew who to talk to at the city. He had, his team in place, and, there's going to be some growing pains for him. It's building a new asset class.
Sure.
But, he's been very diligent in getting educated and making sure, and we work together daily on, value engineering stuff. Today we just got a bill for generators that would choke a horse. So we're working on that right now. So
sure. Nice.
If you need generators, they're expensive as can be. So it's not fun to look at that bill at all.
Absolutely. Now, in all these projects, Lo, let's talk about, sort of the financing side of it, or why it's so appealing. Like, how are the returns? Why not kind of take your company into the traditional multifamily or perhaps the self-storage route that many operators typically operate under, right? Your niche, assisted living, as you said, right? Why not something else? Why assisted living? Give us some sort of numbers or perhaps some genesis around why that class is so appealing.
Yeah. So, look, I think the numbers in assisted living and memory care are compelling, but not so compelling that somebody would want to take on that mission. So I think it's beyond that for me, in that having managed an apartment complex and having sold cars, in some ways those things are commodities. And I really didn't want to be involved selling commodities anymore. I wanted to be offering something that was unique, and I want to be offering something that was a personal service. And so, people come to me all the time, and it's like, hey, mom or dad has fallen 15 times in the last year. She's going in the hospital. And if you could just help me stop her from falling, right? So that's a very personal thing. And so
absolutely.
I guess the best way I would describe it is probably conscious capitalism. I consider myself a capitalist, but I also don't think that, the Gordon Gekko greed is good school of capitalism is doing capitalism any favors.
Sure.
So my philosophy has always been, there are plenty of ways to make money that I would never do, So like, it's very profitable to arm child soldiers. Doesn't mean I want to be in the arming child soldiers business.
Sure.
So what I like about what I do is that there's money in it, but more importantly, I'm being paid to help somebody. And when the offerings in the marketplace are so, they're always missing something. And so it gives us a chance to really kind of rise to the occasion, solve a real problem. And unlike some of the things, I would argue multifamily, that's a need. I don't know that storage is really a need. Nobody really needs stuff, right? But if your mom has got dementia, you're gonna need somebody to help you take care of her. And if your dad falls a lot, you're gonna need assistance. And so, we're really filling a need business. I think of us in the need business and not in the want business. I mean, sure, people choose us because they want to, but they also, they got to go somewhere to get the assistance they need.
Sure. And I appreciate you sharing that. And I kind of applaud you as well, Lou, there, that your thesis about and your outlook about looking towards this is pretty fundamental and pretty, sort of inspiring. I mean, not only you're kind of taking that ethical outlook towards this, but the experience you offer and kind of, bootstrapping yourself to kind of develop your brand, kind of go into this new construction projects and create that sort of brand identity of sorts, and kind of go into this highly competitive space. But at the same time, kind of equip yourself to say that, hey, I want to be in that sort of good, luxurious experience where someone is coming to this grand mansion and be proud. And so it kind of goes, just as you mentioned, it's not just the, just the crude capitalism that we see all the time.
Sure.
It's more about you're offering an experience, you're offering such a need in general, And now speaking of your projects, Lou, give us a sense of, what that investment thesis looks like. What is that ROI and things like that? Because you have investors, as much as you would love to, obviously do good, but at the same time, you want to make sure, the projects are fiscally responsible. You're giving them returns, things like that. Help us understand some of those aspects.
On our bigger projects, I think, the metric. So as developers, right? So obviously there's, you can have so many different metrics. You have cash on cash, return on investment, equity multiple, internal rate of return. You have so many metrics you can look at. And we like internal rate of return just because, it measures time value of money. The other thing too is that a lot of our projects are long holds, maybe 10-year holds, and some investors love that because look, if you're a syndicator and you're in and out every couple of years, then you got to have constant deal flow to solve tax problems for me, or I've got to see if I like your new market strategy. If you put something in for 10 years and it performs well, it's kind of set it and leave it for a lot of investors like that. So typical internal rate of return for us for investors usually at the end of the project is around 20%. Some projects might be 18, some projects might be 22, but around 20% is pretty standard for us. And that's pretty hard to do on a 10-year hold. Most of the time you see those internal rates of returns, at 20 or above. These are like 2-3 kind of really quick turnarounds. And so with us not having cash flow for the first couple of years to be able to perform that, we definitely try to put the investors first and create an environment where, they can do well, but also get really good returns. So like a typical equity multiple for us might be around 3. Someone invests $100,000 throughout the whole project, they get 300,000, something like that. That's probably pretty common for us.
Sure. Thank you for sharing that, Lo. And how does that sort of the structure look like? Is it between the share of partnership? I meant between, let's say, the LP and the GP shares. Is there any preferred return involved? How does that work?
We're pretty project specific. So we haven't done a lot of preferred returns in the past. So we've looked at it. Some of our build to rent stuff, we've done that. It really depends. When I first started raising capital, I realized that there were so many different tools and ways to, interact with your investors, right? And sometimes you can do debt, you can do convertible notes, you can do equity, you can do preferred returns, preferred distributions, all kinds of waterfalls. And what I realized is that different projects called for different tools. And so, we really kind of step back and we always kind of look at different ideas. And so we really haven't had a consistent strategy one way or the other. I imagine in the next couple of years that will probably go away. We'll kind of find what we think works the best for us. But we've tinkered with a few different things on different projects because, look, if all you do is carry around a hammer, the whole world looks like a nail, right? So having the ability to, tinker and look at different ideas. So we've done some convertible notes. We've done some straight equity shares. We've done some preferred distributions. We've done some waterfall stuff. And, ultimately all the projects got funded. So the investors felt good enough about the structure. I generally prefer simple. But sometimes with development, you don't really have that option because, it's like if I'm buying a 90% occupied building, then I can do simple. But if I'm building something, then you almost always have to do it a little bit more complicated to try to engineer a way to ensure the investors get a healthy return for the risk that they take. And at the same time, you leave enough meat on the bone for us doing all the work that, we can, do what we need to do and take care of ourselves as well.
Sure. And also speaking of development projects, Lou, typically we know the land entitlement, kind of going through all that process, of course, building is, no small task as well. So how do you kind of piecemeal all of this sort of risk that comes around, especially the entitlement risk and things like that? So when you kind of go into these projects, how are you kind of safeguarding yourself and not kind of just go belly up midway and things like that? Could you talk about some of all those aspects as well?
Yeah, I think our team has done a good job. I think we have a very elegant solution to that. So there's really there's two risks. There's basically there's risk from the city. So you have your entitlement risk. You have like civil risk, and that's basically that your project's amazing, but the city doesn't let you build it, or they make you change something. They make you spend so much money, the project doesn't work. And then there's market, meaning that can you execute the business plan and can you fill it and stabilize and do all those things? So we've actually kind of created a product where it allows us to separate those two. So actually what we'll do is we'll do a phase one offering, and our phase one offering will involve investors coming in at generally a fixed rate of return. And basically what we do is we hypothesize, hey, if we buy this piece of land and get it all the way to shovel ready status, it's entitled, they've approved everything, everything's good to go, it's ready to go. And we sell that from phase one to phase two. We've added value along the way. And so what we do is we have investors that join us on the entitlement risk. And they're basically betting on us to successfully get the land entitled and then sell it to ourselves, essentially. And then they get first right of refusal to stay in the new deal if they want to. And so we have products. And so, because what's nice too is if you have a friend or you have a family member that calls you up and says, hey, I'd like to place money with you for a couple of years, but I'm doing 10-year holds, I can't help them. But if I'm doing a land deal where I plan to get an entitlement ready and work with the architectural and the civil engineering teams and all the vendors and make sure that we got, the water getting off the site and all that stuff, then we can create that product. And so we've kind of developed two products. We have basically a phase one product that's a fixed rate of return. It's for lack of a better term, it kind of looks a little bit like, mid-range hard money, right? So an investor might get 10%, 12%, sometimes 15% return over annualized. And then the other thing too is that our other offerings are pretty popular. And so they actually get first right of refusal. So for example, on our Denton project, we raised $1.5 million for phase one. We had almost $2 million of phase one money come into phase two. So we lost a few investors, but the ones that we kept actually upped their investment. And so altogether, we had about a 30% increase from phase one to phase two, and they were happy because they basically ensured they had a spot. And so,
and that's a good sign. Sorry to interject, but that's a good sign, Lou, right there, that phase one investors are saying that, hey, we believe in it, we want to increase your share, and kind of having all phase one investors and more kind of going into phase two speaks to the sort of the belief of your investors for sure.
But beyond that too, the other thing that's kind of cool about the way we engineer that. So phase two, really most of the entitlement risk is off the table. There might be a little bit, but most of it, 99%, 90% of it's gone. But what's fascinating is that, if a project takes, say, 5 years to stabilize, when you break it up in 2 years and 3 years, you're kind of starting the clock again, right? So if you look at internal rate of return, if we would have started at the beginning, then, it depresses things. But if we pay those investors off and we start a new project, right, phase two of the same project, then it allows us to, not only pay out some investors early, let them get off the bus if they want to, but when someone stays in, it kind of resets the clock. And so it does allow us to have multiple different offering types. It does allow us to, cater to different people with different needs, but it also allows us from a financial engineering standpoint. And it just allows us to, start the clock at a different time. And that look, an entitled, ready to build project is very different than a raw piece of land. And you just sort of hope the city's going to go along with it. So
Absolutely. And did you say, Lou, in between that phase two also involves maybe a couple of phases in phase two itself, so that you protect?
It could. Yeah. So generally when we'll generally buy a little bit more land than we need so we can build more phases of buildings. Yeah. I mean, you could break it down in multiple steps and multiple phases, but fundamentally phase two is, for us, construction of the building, getting their certificate of occupancy, stabilizing and filling the building, refinancing all the way to disposition. Phase one is basically getting it ready for shovel ready status. And so it's a very different process. And look, there's some risk in phase one, and that's why we pay a good rate of return. But ultimately, since we're the inline customer, the only risk is, can we not sell it to ourselves? Did we not, create value? And so that's kind of the way we do things. Yeah.
Sure. And phase two, part one would be perhaps, you kind of continue the build out and you bring it to completion, and perhaps phase 2B in that would be kind of the lease up and stabilization. But does that sound about right?
Yeah, and then we do a refinance takeout, and then obviously eventually we hold until we dispose of the asset.
Sure. And what's that long-term hold look like? You said 10 years for sure, but is that the phase where you're saying, okay, I'm stabilizing the whole occupancies, kind of, setting up all the operations and things like that. And the eventual disposition that you referred, Lou, is that more kind of then based on, let's say, my grandiose NOI, and can I find a bigger REIT or some bigger operator who can kind of consolidate, sort of your luxury project into their fold? Would that be the exact plan, but perhaps?
Yeah, I mean, the interesting thing is that it could be a lot of things. So we've thought about this a lot, and who knows what's going to be happening 10 years from now. But because these are individual houses on one campus, theoretically, if you wanted to buy one house, I could sell you one house and keep it under common management. I could just sell the project. The other thing that may happen, our model is so different, is that maybe one of the really big players in the space, especially now with COVID, right? Because COVID's kind of influencing senior housing in a lot of ways. What if a big player, comes in and is like, look, I love what you're doing. I don't understand it. I'm just going to buy you. Right. So they may try to do an MMA, or someone can come in and say, you know what, you've got 10 of these communities in Texas and 3 in Louisiana. We'd like to buy the whole portfolio. And then, so we sell it like that, because once you get to 1,000 beds or 1,200 beds, 1,500
you're
beds,
institutional. Yep.
Yeah. You're creating a lot of efficiency. So we're keeping very tight geographic areas. And so, we may not look outside the state of Texas to do an acquisition, or certainly not a development, maybe ever, because there's just no reason. There's enough things happening in Texas that if I could probably spend 10 years doing it in Dallas, and 10 years in Houston, and 10 years in Austin and San Antonio. So it makes it nice, because you have a very tight area that you have to operate in. If your executive director goes on maternity leave, you can plug somebody else in from a sister community.
Makes perfect sense. Now let's shift gear a little bit. Your model about build to rent, perhaps your partner kind of champions that torch, so to speak. What's the thesis there? Like, is that houses, apartments, multifamily? What does that look like?
Yeah, so we focus on townhouses and duplexes at present. We like townhouses depending upon the density and the things required from the city. So our latest project is actually a combination of townhouses and duplexes. We love them because there's a lot of people that don't want to live in an apartment. There's a lot of people that are looking for 3 and 4 bedroom type of stuff. And right now, our primary market, we kind of have a blend of families and a blend of students. We have some professionals too, some nursing people, things like that. But we're in a town that has a bunch of colleges. And so, we'll get 2 or 3 students with their parents co-signing as roommates. And we'll also have, a family of 4. And maybe have a little dog and they want a little yard. And so we're able to offer product that it's a kind of a class A product at a class B price, very attractive in the marketplace. And you don't have a neighbor upstairs, jumping on the floors like sometimes you have with apartments. I think our real, one of our keys to our project is, in de-risking it, is we individually plat each unit. And so,
interesting.
If we build 90, we have an 89 unit complex that we're building right now. We're building it in phases of 30, basically. And everyone's individually platted. So here's the thing. We can run it like a multifamily. We can have we can run it like 89 units, all feeding into common management. It's all run like that, all that. We could also, again, sell off chunks of it. So, one investor's like, hey, I would like to buy these 8 duplexes, get the price and keep it under common management. But here's the thing. If 10 years from now, if we've all seen a trend where renting has gone up and home ownership has gone down. What if that reverses in 10 years? Well, then we can make a couple of improvements and now we can sell them to homeowners. So we have a lot of exit strategies that are very attractive. And the other thing that allows us to do is in multifamily right now, there's something called the amenities arms race. And what it is every building you go to, it's like an arms race. Who can have a better amenity? Like, not only do we have dog washing stations, we have dog yoga, and it just gets out of control. And for building operators, it's a distraction. It's expensive. If you bet on something that's wrong, then you have problems. We don't have to do any of that. So we don't have pools and we don't have gyms and we don't have all those things, but they lease like hotcakes. And the reason is because some people just want a single family home and they just want to, have a little yard. And so our unique selling proposition is a single family home with a yard or, sometimes a front yard, sometimes side yard, sometimes a backyard with a garage. And, some people really want that. And so it kind of attracts a different type of buyer. And so we love it because we're not having to do like everybody else that's developing apartments, which is you got pools and gyms and, a wine tasting deck, and it just gets out of hand. So we can avoid all that and bring a product to bear that has a very competitive price. So we're building, let's say 1,500 square foot duplexes, and we're renting them for $1,800 a month. And it's very attractive. And, it's an A-class product in a B-class kind of price range.
Sure. And makes complete sense. And I think, and the back page of all of this, I think, Lo, that I like is that there's synergy there. Like, the construction, your background, it's not like, you're completely going off in all different directions.
Sure.
Perfectly ties into, like how you are developing within the assisted living space as well, so that makes complete, sort of synergical sense there for sure. So with that in mind, Lou, I know you have invested in a lot of passive deals. You speak passionately about how to kind of, vet the deals, the sponsors and things like that. Could you maybe perhaps talk about some of your philosophy around, like how you vet syndication deals in general?
Yeah. If I was going to boil it down to one thing, because I know obviously we talked and, I put out this list of things to look for. And, I think the most important thing is that it's really all about who runs the deal and not the deal itself. And, ultimately, one thing I love about our company, and there's some other companies that do this, as well, if not better than us, is that we're involved in operations. So many people, and this is not a knock on them. So many people, they build things, they buy things, and then they hire someone else. And I mean like a third party company to do everything with that. And man, it is great for growth. It is great for expansion. It is great. So you can jump on Facebook and go, oh man, I bought a 200 unit apartment complex. But as we run into challenges like COVID and the economy and all those things, man, operations get really difficult. And
absolutely.
So I like to invest in people that fundamentally understand operations. I like to invest in people that if push come to shove, the sponsor can jump in his car and go talk to a client. The sponsor can hire a leasing agent if they have to, because at the end of the day, there's a measure of fear that happens. If you created all this money and all this wealth and you don't really know how you created it, then if you lose it, you don't know how to get it back. You got to get somebody else to do that for you. And so I really like people that are in operations. I really like companies that understand operations, that keep operations in house. I like companies that communicate well. I like companies that I like the sponsor's vision, where the economy's going. Because the truth is that as we've seen in this current time, there are people that are winning, that are doing better, and there are properties that are doing better than they were before all this. And so it's really about just doing things that when times are tough can be defensive, and when times are great can go on a good run. And so that's the reason why we've chosen some of the asset classes we have. A lot of my passive investments, honestly, are in affordable housing. RV parks, things like that. Some multifamily that's kind of a class B, kind of class C area, because ultimately, we really like that kind of middle of the road, not necessarily workforce housing, but maybe like professional housing, but, kind of inexpensive professional housing. We love that business because, ultimately, if your apartment, you need to be close to your job, you need to be close to your kids' schools, things like that. If it's an RV park and you're a temporary worker, you're staying there to, finish the electricity on a project or whatever it may be. So we really love affordable, in my assisted living memory care business. And we're not really affordable because we're not leasing to people with jobs, right? We're leasing to people that have built up net worth, and we built up, they have long-term care insurance, so on and so forth. But in the housing space, we like affordable. We like things that, if you're a very fancy person living in a class A building and times get tough, you consider moving into a nice class B building, right? Sure. And if you're a tenant that's, working in a workforce housing type environment and you get promoted at your job, then you're going to probably upgrade to a B class. So that, and that's one of the reasons the rent is just the idea. So a lot of our passive investments share that philosophy. We love that sort of B class, sort of on the line between, middle class. We love that space because we think that's where a lot of opportunity is, both to step up and step down in good times and bad.
And I like that thesis actually, Lou, and it kind of pretty much jives with some of my personal philosophies as well. Is that, being an owner operator for, I guess 2 decades now, I kind of seen, a lot of things come and go, of course, and that belief in execution and operations that, you kind of know the being in the trenches, how things work, what to look for when you scale, what things could be challenging, all of that can be exactly extrapolated. And you're also the things that you mentioned about how someone can downgrade or upgrade, or even just the general resilience in the workforce housing in general is such a fundamental thing that's not going to go anywhere. The volatility is so low within that space that if you're in there, I don't believe that any of sort of the pandemic of sorts can sway you, so I always, have that belief, and, it's not going to go anywhere for sure. So thank you, Lou. I appreciate your time today.
Thank you.
How about share some contact information as to how folks can reach you and learn more about your company as well?
Yeah, sure. So a couple options. If they want to shoot an email to me, my email address is LOE at GoodHornCapital.com. So GoodHornCapital.com. And they can shoot me an email. If they want to learn more about the assisted living business, we have a book on the website. They can just go to GoodHornCapital.com, and you can download a free ebook that basically tells the story of my company, Sajoke, and kind of how we got started and kind of our philosophies on things. So if they want to learn more about that, they're welcome to do that. That book is totally free. So GoodHorn Capital is probably the best place to go, and real easy to get a hold of us there.
Awesome. Thank you for coming on. For viewers and listeners, our website is premiumcashflow.com. We have, great guests like Love all the time, sharing lots of insights into different spaces, and would love to, have you, if you're interested in learning more or knowing, how passive investments work, kindly head on and register yourself. We can have a short conversation and figure out, what interests you and how we can help each other. So it's been a pleasure, Lo. Thank you for coming on today.
Yeah. Hey, thank you for having me on the show, man. I really enjoyed it.
I appreciate it.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.